Hey friends, our world is changing right now, and so is my dividend stock portfolio. With the very high interest rates and global uncertainty, I am positioning my portfolio for the future. Now, I rarely sell stocks from the past, but I want to share 15 positions today that are on my watch list as I look towards the future. These are the 15 stocks that I am actively buying right now in my personal portfolio, and I adjusted this list in particular for the very fact that CD rates right now are up around 5%. That's right, I was looking at CDs, certificates of deposit, with my wife last night, and they are yielding 5%. And when interest rates are that high, I want to make certain that my dividend stock portfolio is adjusted for that type of interest rate environment. So I'm going to go through those 15 stocks today, but before I do a fun illustration, a fun metaphor on the whiteboard for all of you. I hope you already noticed, but I have some hunnets up here. I have both the new ones, but also the old school hunnets because I'm an OG Thug Life dividend stock investor, but they are secured to the whiteboard with blue painter's tape from 3M Company. Now, these are meant to illustrate two types of investments. The first type are the bonds and CDs. Those are investments in the US dollar, the currency, and they pay interest in the US dollar, the currency. They're really betting just on the continuation of the value in the US dollar. But the second type of investment, that is described or illustrated through the blue painter's tape. That is my bread and butter core dividend paying stocks. And when I invest in dividend paying stocks, I am investing in operating business. I am investing in businesses that throw off cash flow, that can earn money in any currency, that have trademarks, that have operations, that have property, plants, equipment. They have employees. They have competitive moats. They have secret sauces. They have all of that, and they can continue to thrive and grow despite what currency they're kind of interacting with at any given time. Now, with the fact that bucket number one is yielding 5% right now, I am looking at bucket number two as a dividend stock investor as trying to replicate that 5% yield more or less, but with some dividend growth over long periods of time. And that's what my watch list is all about today. Get ready, everyone, for a really exciting dividend stock investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So I want to jump right into it. As you can see on the screen in front of you right now, that is my 15 stock dividend investing watch list right now. These are the 15 stocks that I am actively acquiring right now, and they are listed in ranked order of which ones I like the most, all the way down to number 15, which I like the least, but all 15 made the list, so they're all incredible investments for my personal situation, that is. I want to start out with Johnson & Johnson. I'm not going to go through every position here in such great detail, but I want to quickly go through all of them and point out what compels me to buy each of them. First and foremost, with Johnson & Johnson, with a starting dividend yield of 2.96%, that does actually entice me to buy it. It's nice to see the starting yield higher, but quite frankly, it's going to take some time for that yield to reach parity with the CD rate right now, quite frankly. It's going to take time, probably, I would say, about 9 years or so at its current dividend growth rate. And so that's not exclusively what draws me into Johnson & Johnson. What really draws me into it is the fact that the forward PE right now, as highlighted on the screen, is a 14.5 this year and a 13.96 next year. These are deep value levels, I would say, for such a high quality core 5 stock. And so I am buying Johnson & Johnson right now for the fact that it is trading at deep value. Now, is it providing meaningful cash flow at 3% qualified dividend? Yes, but again, it's not quite up at that 5% range, but this is a list of 15 stocks, and what I do not receive with Johnson & Johnson, I compensate with other stocks like the number 2 position on this list, Altria. I look at Altria as high yield, but I also look at it as future core top 5. And so this is actually something I want to take a pause here. Many of you who watch my channel know I've talked about the core 4. I'm kind of changing my concept now from core 4 to core 5. And the reason is I want Altria in that list. That's right. I am adding Altria to my top 5, and I'm actively building this position right now to make it into that top 5. And actually, there's some news with Altria. I want to do this really quickly because this news kind of baffled me. Actually, it goes against kind of what I'm excited about with Altria. I thought they were beyond all of the mess with JUUL. But as you can see on the screen in front of you right now, it looks like they're apparently going to acquire another company that is JUUL-like. It's called NJOY. They're going to buy it for about $2.75 billion. And I guess it's kind of similar to what JUUL does, but they've been blessed, I would say, it seems, based on this article, by the government and by the regulating authorities, I guess, in ways perhaps that JUUL was not. But put in the comments below, do you think this NJOY news is good, or it's just going to be another repeat of the horrible mess that JUUL created for this company? We shall see. But as you can see on the screen in front of you right now, what I want to share with Altria and what it offers to me is an amazing starting yield right now of 8.15%. On top of that, they're growing the dividend by 7.3% per year, and the PE ratio is in the 9s this year, 8s next year. I guess Altria is a rare stock on this list. It provides the best of both worlds. It provides superior dividend growth, even better than Johnson & Johnson over the last 5 years, but it also provides superior starting yield. It's one of these rare stocks, but of course, it contains risk, perhaps more risk than J&J, but some days I think it contains actually less risk than J&J just because they've already been through the master settlement agreement. I want to keep going. As you can see on the screen in front of you, I've got my number 3 stock on my list that plays a completely different role. This is core 4. Well, now I would say core 5. It's quality PepsiCo. I don't have much to highlight on there at all because it's expensive. The starting yield in our current interest rate environment isn't that high. It's 2.95%. The dividend growth rate over the last 5 years, even though the recent increase was pretty substantial, it's only been 6.4% per year on average. I can't see them doing that much better than that over the next 5 years. So what PepsiCo brings to this, and what I really want to share with all of you today, is this is a basket of stocks. This is 15 stocks that could more or less comprise a hypothetical portfolio. Each stock in the list plays a different role, and what Pepsi brings to the list is quality. It does one job, and it does it well. It does quality. It's a sleep well at night swan dividend stock. But I want to keep going. As you can see on the screen in front of you right now, the next one is McDonald's. And with McDonald's, I thankfully have one cell to highlight, which is 8.5% 5-year dividend growth rate. So they got the high dividend growth rate, but the starting yield is low. PE ratio is high. Quite frankly, with McDonald's, it's the same story as PepsiCo. The role that it plays in this portfolio that I'm sharing with all of you today is quality. It brings quality. And you'll see this portfolio, it is meant to mesh my core 4 strategy with the reality right now that I need higher yields for my living expenses, and just where our environment is right now, where our economy is at right now, yields are higher. And so I have to adjust my strategy for that. It doesn't make sense in dividend stocks for too long of a period of time for my starting yields to be substantially lower than the prevailing CD rate. But I'll get more into that later as well. Let's keep going. As you can see in front of you right now, the next one I want to share is British American. I don't have too much to say here other than it falls into the same line of reasoning as Altria. And so it's a deep value, I would say, kind of like Altria, but it's also a high yielder. And so that's BTI. I've got my Home Depot bucket here again, by the way. Hope you enjoyed my last video. I will link to that in the pinned comment below. If you haven't seen it, you got to see it. I had this Home Depot bucket and I brought all kinds of cool goodies out of this thing. I got some props today, don't worry. Of course, I got the Hunnits, but I got some more props as well. So stay tuned for those. But I want to share on the screen with you the Home Depot right now. The Home Depot comes in on my list as number 6. And the reason it's on my list is it's a core top 10 stock. I see some value there. I didn't highlight it, but the PE ratios in the 18s this year, 17s next year. I love the dividend growth rate. This is my fastest dividend growth stock. It's growing the dividend on average by 15% per year. And so this brings core value to the list. I would say Pepsi and McDonald's, they just kind of bring core to the list, core quality. This, I would say, also is kind of core quality, but it's also core quality with a component of value because it is trading at value levels, in my humble opinion. The next one on the list, I don't have a prop for it, but it's Universal. No, they don't make the movies. They farm the leaf that's used by British American and Altria. What is so cool about Universal right now, it's trading at book value. It's trading at a forward PE of 13. It has a starting yield of 6.18%. It's a qualified dividend. The dividend growth rate I don't highlight because it's probably misleading. They're not going to grow that dividend growth rate that fast into the future. They had a one-time increase a few years ago that was substantial. That's why the compound annual growth rate there is high. But that's Universal. Now, I love Universal because it plays a completely different role on the team. I'm trying to assemble a team here so my portfolio more or less looks like kind of bucket one here, the CDs and bonds, but I've got it by investing in operating businesses and operating businesses that are growing their dividends, that pay qualified dividends that are taxed for me much more effectively than the interest that's paid in bucket one here. And so anyway, Universal, it obviously plays a role on the team, and it is a role of cash flow generation. I love that 6+% starting yield and the fact that it's just trading at book value. I never worry about spending the dividends from it. I'll link in the pinned comment below, but it actually is probably my number one stock for just bill paying power because I never worry about spending my dividends from Universal. I don't reinvest it, don't worry about it, but I am buying more shares so I have more cash flow to spend. And so that's the role that one plays. As you can see on the screen, the next one I want to go through in my watch list right now is Bank of Montreal. This is a fun one. I want to point out something though. On the column here on the percentage off 52-week high, it's down 21%, but you look at a lot of stocks on this list, they're all trending down. They're all trending down a lot. I love that. As a dividend investor, it's so exciting to be in an environment finally where stock prices are down. But I love BMO. It's trading at under a PE of 10. This is a company that's growing quickly. The starting yield is 4.46%. Yes, there's foreign withholding tax, but I can claim it back, at least in my personal situation, as a credit on my taxes. Of course, this isn't tax advice. Make sure to consult with your licensed tax advisor for those types of topics. What I love about BMO, though, it just surprises me. It's kind of a sleeper in my portfolio. I never thought it would do this, but it's growing the dividend on average by 7.3% per year, and that's priced in US dollars when I'm converting it back to dollars, looking at it that way. But what Universal did for me is just pure high yield. What BMO does for me is I'd call it like high-ish yield. It's a higher yield in my portfolio. If I were speaking in Stephen Bavaria terms, I reviewed the book The Income Factory recently. I'll link to that in the pinned comment below. Thank you to my friend Greg, the Dividend Monster, over on Instagram for suggesting that book to me. I guess Bank of Montreal might possibly almost qualify as Income Factory light, although it's probably not there yet. But anyways, that's how I look at it in my portfolio. That's why I say it's a high-ish yield, but it's got that dividend growth. That's what I really love about it so much. It'll continue to grow the dividend. Anyway, I must keep going. The next two on the list are both utilities, number 9 and 10. I like Southern a little more than Duke, but I'm going to combine both of them here and talk about them at once. What I like about them is the stocks are finally trending off their highs. They're both down over 20%. The forward PEs are now down in the 17s and 15s next year for Southern, 16s this year, 15s next year for Duke. I love the starting yields in those kind of mid 4% range. Of course, dividend growth rate is slow, but I'll tell you something. These ones play a role in the portfolio. I haven't got into it yet, but I got risk in the portfolio. I got 3M. I put the tape here for a reason, and 3M's the last one in the portfolio, but I want to talk about that. I got others in the portfolio like Altria that have some risk. Hey, even the Home Depot has risk. If our economy continues to go the way it is, home sales just dry up, no one has money for home improvements or a need for home improvement, Home Depot can fall on hard times. But I'm going to tell you something. I couldn't film this video right now if I didn't have electricity and I didn't pay my electricity bill. Probably the last bill that anyone would think about not paying is electricity and their utilities that they need. And that's why I love investing in Southern and Duke here, because they pay these nice dividend yields. But also, I have a level of worry with those stocks that is about as low on the list as I would have with treasuries and CDs. And so there's so many parallels there with the utilities. And finally, they're adjusting in share price for the interest rate environment that we're in right now. But what's great about them is they pay the qualified dividends, which is better than interest from CDs. And what's so exciting is they have an element of dividend growth. And what I would say about everything on this list, with a CD, what I don't like is I lock up the money for a few years, but what then? 3 years out, 5 years out, let's say the interest rates are much lower. Then what do I do? But with dividend stocks, especially quality ones that tend to increase the dividend year in and year out, I don't have to worry about that. There's no expiration date. Set it and forget it. Buy it, hold forever. Check back in 10 years, 20 years, 30 years. Hopefully they just keep increasing the dividend. I don't have to worry about that concept of kind of resetting the yield like I have to with bucket one. But let's keep going. As you can see on the screen in front of you right now, I want to go through a few more stocks today. I got Pfizer on the list. It's a controversial one, but I love the PE down there in the 11s this year forecasted. 10 next year forecasted, starting yields 4%. I look at it as a high-ish yield. I also kind of look at it as deep value in some ways. Boy, I think it is a value right now because I think people are scared to own it. I'm willing to take on some calculated risk. There's rarely a free lunch. I look at risk when there is risk that I'm comfortable with, that I can kind of shoulder, I go for it. And that's how I create value in my own portfolio, just speaking to my personal experience. I got Leggett and Platt on there. I like the fact that the starting yield is 5%. I hate the fact that the payout ratio is over 100%. Maybe this one is kind of a contrarian turnaround one here. I'm getting some yield, but I'm kind of betting that it's just having a cyclical lull right now and that it will turn around perhaps in the coming years. This is lower on the list for a reason. I want to talk about something though. I got to look fresh and clean. I do this all day, every day. I got the Unilever Dove soap here, sensitive skin, but I don't just have one. I got a lot. I got 1, 2, I got 3, I got 4, I got 5. I got about 20 more of these things. I gotta always stay fresh and clean. But hey, Nelson Peltz, I hope you're watching this video, activist investor friend. Get in there with your Unilever and turn this thing around for me. This is another contrarian turnaround for me with a high-ish yield. You can see, other than some of the core stocks I talked about today, which just bring quality, like PepsiCo and McDonald's, just sheer quality to the portfolio, Home Depot too. I've got a theme here, and a lot of the stocks, they're going towards high-ish, higher yield. And as you can see on the screen, that's what Unilever does. Unilever right now, it's trading down from its highs. You don't see it on the list here as much because I guess in the last year, it had already traded down a lot in the previous years. So it's only down 4.7% from the 52-week high. But again, it has a 3.66% starting yield. Not bad. It's a kind of high-ish yield. And I basically look at it as a top 20 stock with some value, some yield. I guess I don't even put it high-ish yield. It's some yield here. I want to talk about Kimberly-Clark because I don't know, put in the comments below. I'd be curious about you and your family. Have you gotten a lot of sickness, illness this winter season? I don't know, but our family, we faced a lot of different colds and viruses this season. I'd like to know, is this just something all over the world, all over the country, or is it just with us? I'd be curious to know. But anyway, these always come in handy. Kleenex from Kimberly-Clark. I gotta have the props. Gotta have the props. Who got the props? I got them. And so let me show you on the screen right now with Kimberly-Clark. This is another one, kind of like Unilever. It's a top 15 for me. I see some value, some yield. Yeah, the yield's not that high, but 3.78% on a qualified basis. I'll take it, especially because they're growing it on average by 3.4% per year. Not huge, but it does something better than the CDs that go nowhere. And I look at it as quality with a higher yield. It's not the kind of quality that Pepsi or McDonald's are, but it's quality for sure. Now, I got one more I got to share with you today, and I'm searching for my prop here. I got it. I got the blue painter's tape. I got so many rolls of this. It's 3M. And so I had to do it. I got the 3M whiteboard. I got the 3M tape holding up those $100 bills. 3M, surprisingly, is on the list, and I want to share why. As you can see on the screen right now, there was some really good news yesterday, and this was from the Department of Defense. And basically, the government, the Department of Defense data is showing there's no hearing loss. 90% of the time, it seems, based on this press release I read. And so there's so much worry about 3M because of the litigation right now. But when we look at the facts coming from the Department of Defense, I think there may be less risk with this stock than a lot of people think. It's lower on the list because it is higher on the risk. And as you can see on the screen right now, 3M, what I love about it is the starting yield, 5.44% on a qualified basis, and they're growing. So it's higher than the CDs, and it's growing at 2% per year on average. It'll go higher, hopefully, that growth rate in the future once they get through this litigation. But it's trading at a deep value PE of 12 this year, 11 next year, and that's really, really deep value. And the reason it is such a deep value is they're in a cyclical lull right now. And this stock, if the EPS got back to where it was during the cyclical peak, that PE would be even lower. It's a contrarian play for me. It's deep value. It contains risk. That's my 15 stock watch list portfolio. But I want to share with you, as you can see on the screen, I have the averages at the bottom. And now check it out. The average yield here, 4.54%. And the average dividend growth rate, 5.3%. I have a little tally now at the bottom of the screen. And what you're going to see there is, okay, I start with 4.54% in year 0. And I grow that on average by 5.3% per year. Well, just to reach parity with the CD, not putting, taxes into account, obviously off the bat it's better than the CD because these are qualified dividends, but it's year 2 that it gets to 5.03%. But I invest really to get to 10% dividend yield on cost. When does it get to 10% dividend yield on cost? About year 15. This is important that I show this chart to you. And the reason I'm showing this chart, quite frankly, is to share a thesis I have that dividend growth rates going forward, not only have they been slower, the last 5 years, I'm just looking at the basket, it's in the 5s for the basket I've selected. Now I could skew my basket towards a different 15 stocks, but what I'm saying is I actually believe it could be even lower. I did a video a few weeks ago. I'll also link to that in the pinned comment below. But at the end of the video, I don't even know if everyone saw it. That's why I want to share it again. Check it out on the screen. I pulled this directly from my last video. These are just some risk factors I see. I see some risk factors with the economy stagnating, and I also see some risk factors just with the stock market going nowhere. And why would the stock market go nowhere? It would go nowhere because the economy is stagnating. The stock market is a reflection, if you will, of where our economy is at. And where the companies are at with their earnings. I am positioning my portfolio a little bit these days for higher starting yield because I believe what I just shared in the model with the slower dividend growth rate, I think that's what it's going to be or worse. And if my goal is to kind of get to 10%, it's going to take a really long time to do that with slow dividend growth rates. I might as well start with some higher yields now just to get the cash flow going and optimize cash flow the best I can. Now, I am speaking, though, not only to the economy and where I see the economy, but where my life is at as well. I'm in my 40s and I'm using cash flow now, and I have a need for even more current cash flow to pay bills. And so that's part of the story as well. But I want to close out with a few slides. Before I do, if you enjoy the video today, please go ahead and smash the like button. It really means the world to me. I'm so appreciative of all of you who choose to watch my channel. And also don't forget to subscribe with the notification bell because I do have videos all the time. And also I'm doing shorts these days. They're kind of fun. Hopefully I'll have a new one for you in the next few days, but check out my shorts. They're a lot of fun, and I'll link to the most recent one in the pinned comment. But I have a few slides. Check it out on the screen right now. The first one is just, hey, here's my new strategy. I started out the year with my core 4, and then interest rates just kept skyrocketing. And CDs are at 5%. Yeah, it would take about 9-10 years for J&J to reach parity with the CD rate at their current dividend growth rate. This got me thinking. And so I'm shifting my focus to a blended focus of core quality, as in my core 4 and now core 5 because I'm trying to put Altria up there. But I want a component of dividend growth, but I want a current yield on parity with the CD rates. And so that's my new strategy, and that's why my watch list has these 15 stocks. The thing that these 15 stocks share is they're all dividend stocks, but other than that, they're very different types of dividend stocks. But when they work as a team in a portfolio setting, they work for my personal financial goals, which is so fun. But as you can see on the screen right now, the last thing I want to share is just the benefits of my strategy. I hit on some of these points in the video, but I want to remind everyone that qualified dividends are a better tax consequence here in the United States than interest income in general for most investors, at least in my personal situation. I'm trying to build something that can last forever while bonds and CDs have expiration dates. Now, mind you, I do own bonds and CDs, but that's more for emergency funds or just cash savings. I would say that bonds and CDs are all about placing huge value on the US dollar, but dividend stocks are all about placing huge value on operating businesses with real, tangible assets, just like the blue tape you see on the board right now. All right, everyone, I hope you enjoyed the video today. I can't wait to see you in the comments below. A friendly reminder for all of my corner patrons. And so I got a Patreon. I'll link to it in the pin comment below. Over on Patreon, one of my favorite things on the corner Patreon tier is my Zoom meetups. And I have a Zoom meetup actually tonight at 7 p.m. Mountain Time, though by the time you see the video, in fact, it will have passed. It will be Friday. But don't worry, I have these Zoom meetups on corner Patreon all the time. I'm trying to do them monthly these days. But anyway, thank you for checking out my corner Patreon. Before I go today, in terms of a full disclosure, I own all of the stocks mentioned today. I got to take a look here at my computer screen to pull them all. In terms of full disclosure, I'm long Johnson & Johnson, ticker JNJ. I'm long Altria, ticker MO, Thug Life. I am long PepsiCo, ticker PEP, McDonald's, MCD. I am long British American, ticker BTI, Home Depot, HD, Universal, UVV. I am long Bank of Montreal, BMO. I am long Southern SO, Duke, DUK, Pfizer, PFE, Leggett Platt, LEG, Unilever, UL. I am also long Kimberly-Clark, KMB, and I am long 3M. I own those stocks in my personal dividend stock portfolio. In terms of full disclosure, I'm also long Treasury bonds and CDs. Before I go, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. I'm just sharing my journey here with all of you on YouTube for fun and entertainment. If you're going to go out and invest in the stock market, anywhere else, please consult your licensed financial advisor first. It's possible to lose money in the stock market, in the financial markets. Also, in terms of full disclaimer, I am not offering any tax advice. Make sure for any tax decisions to go ahead and consult your licensed tax advisor. Please see the description below for additional disclosures and disclaimers. I love you all. I appreciate you watching, and I'll see you in the next dividend stock investing video.